today we start a complete masterclass about Forecaster Terminal, and we will have a look inside deep inside the Forecaster Terminal, and I will teach you how to use the Forecaster Terminal from scratch. So let me share my screen and let me start with this special masterclass that will be today, but will last, I think, 2 or 3 weeks. It depends on how fast we will go and from how many questions you have from your side. So you should see my screen, you should hear my voice, you should see also my face. Can you please give me a feedback? Everything all good. Perfect. Thank you, Anil. Thank you, Sven. Thank you, everybody. So, as I told you, we will deep dive inside the Forecaster Terminal because Forecaster Terminal is a very powerful tool, but at the beginning, I understand it could be a little bit overwhelming because we have so many things inside that could be a little bit overwhelming. And this is why we decided to organize this complete masterclass that will teach you how to use the forecaster from scratch. Okay, so as you can see, Forecaster is a very clean software, is a very simple software because the aim of the software is to help you understand the market and help you save time in your analysis. And actually, as you can see from the interface, it's it was developed by as Google is. Okay, if you go to Google, as you can see, you can find all you can find the search bar here, and if you go up here in the page, you can find all the tools, all the app from your Google account. If you go to the forecaster, you can find exactly the same page because you can find the search bar, and if you go here on the page up right in the page, you can find all the tools. Okay, so this architecture, let's say, is very simple, and it was designed in order to use the software in two specific ways. First of all, you can use the forecaster terminal in order to analyze a specific instrument. Okay, and of course you can go directly to the search bar and you can search the instrument, the financial instrument. Could be an index, could be a stocks, could be a commodity, could be a forex. You can search for everything, or you can get ideas from the forecaster, and to get ideas you can go through the tools you have in your account. Okay, so these are the two main ways you can use the forecaster terminal. So today we can start using the old way, the forecaster terminal, let's say, and we can start, for example, with analyzing an index. Okay, let's go, for example, to the S&P 500. Okay, very simple. As you can see, you have different layers inside the forecaster terminal. You can find, for example, the overview, you can find the seasonality, you can find the overbought, oversold, you can find the quote report, and you can find the ranking layer. Okay, why we have so many layers for every instrument you find in the forecaster terminal? Very simple, because on every layer you can find a different approach to analyze the specific instrument you are watching to. So for example, for the S&P 500, you can find the seasonality, you can find the overbought and oversold, where you can find a more statistical mathematical approach. You can find the COT report. Okay, COT report is a very nice style of analysis for the ones connected that doesn't know what COT report is. Very simple. If you go to the cftc.gov website, which is the Commodity and Future and Trading Commission, every week this commission publish a special report. The name is Commitments of Traders. Here is the name. And this is a special report they publish every week, where they tell us where they tell us exactly if asset managers, leveraged fund, and all the other categories of the markets are long or short on a specific future. Okay, and this is why, for example, the COT report layer, you can find it only on financial instrument where the futures are available. Okay, and this is why, for example, if you go on the Nvidia page, of course you can find the seasonality, of course you can find the overbought and oversold, you can find the fundamentals, you can find the political page with all the trades from the United States politician, but of course you cannot find the COT report, because Nvidia is not a listed future, and so we do not have a COT report from for Nvidia. Okay, so as I told you, for every financial instrument available on the Forecaster terminal, you can find different layer, because thanks to this different layer, you can do a different kind of analysis. The goal of the Forecaster is to give you in the same tool different approaches in order for you to have a complete idea for a specific instrument. Okay, is it clear, guys? Of course, all the data inside the forecaster are updated. We do not have at the moment real-time prices for instrument prices, but of course, for example, for the COT report, when they publish report, the report, we have a real-time update inside the forecaster. Okay, perfect, very clear. So this is very important. We have two different approach in using the forecaster. You can go directly to a specific instrument. If you would like to analyze a specific instrument, you can go directly to this instrument and you can analyze with different approaches, with different glasses, let's say. Okay, or if you need investment or trading ideas, you can go and use all the tools available inside the forecaster in order to get ideas. Okay, so these are the two streets you can you can you can go on when you start to use the forecaster. You can start with the search bar, or you can start with all the tools. Today we start with the search bar. So for example, let's imagine we would like to analyze the S&P 500. Okay, very simple. We have an overview page where very easily we can find all the performance for the last one month, 6 months, this year, 1 year, 3 years, 5 years, 10 years, 20 years, and all history. Okay, you have the performance divided year by years. And what is very nice and very interesting is that directly on the chart of every indexes and of course every stocks, you can directly plot something like sales, net income, the price earning, and the price earning weighted. You have to know that all the time you hear an analyst talking about the price earning for the entire index, he use a not averaged, a not weighted version of the price earning. It means, for example, at the moment, the price earning every analyst across the globe use is a price earnings, which at the moment is 24.7, which is not weighted. What does it mean? It means that in this calculation, the weight for NVIDIA is the same weight for every other stocks inside the S&P 500. And this is something really stupid. And this is why, in my opinion, because it doesn't make sense. Okay. And this is why we decided to have also the price earning weighted version. Okay. Where, for example, NVIDIA wait for its capitalization. Microsoft Microsoft PE wait for its capitalization. Okay. And of course, this is why, for example, I don't use the price earning a lot because it's a metric that I really don't like. What I use is the net income because, as you can see, especially if you go in the past, something really amazing, it's directly in front of our eyes. Okay. As you can see, the entire stock market, but of course we will see some example also with stocks, goes up when the net income goes up. Stock market goes down when the net income goes down. And this is a rule that works for every market all across the globe. Okay, and this is something very important. This is why we decided to have this metric directly on the chart. Okay, because for example, at the moment, something very interesting we can see directly on the chart is these guys. At the moment, the net income for all the components of the S&P 500 is more than $2 trillion. And as you can see, compared to the last year, the net income is rising, okay, is going up. And this is something very interesting because at the moment, even if Mr. Trump, the new United States president, is doing something crazy on the market with his tariff and with everything else, at the moment, the components for the S&P 500 are doing very good, net income speaking, okay? So this is something really amazing to have directly on the chart because especially with the single stocks, you can understand if a company, for example, is going down, okay, on the market, but at the same time, the results are really nice. And during our webinars, we had many example of company that for many reasons they were going down in the stock market, but at the same time, the results were really nice, okay? And this is exactly what is happening right now with the market. The numbers are great because, as you can see, never in history results as so good like they are right now, but at the same time we had in the last weeks prices tumbling. Okay, perfect. Okay, so this is the first layer, and of course you can have an idea of how it's going the market. The next one is seasonality, and this is one of the most important layer inside the forecaster. It was also the first layer we had inside the forecaster when 2 years ago we started the forecaster. This was the only layer we had at the beginning, and this is something really amazing because the seasonality is a very powerful tool. Okay, as you can see, by default, you have 3 and 5 year seasonality, but of course, you can add all the other seasonality and you can go until 30-year seasonality. In general, just to be clear with you, I never use more than 15-year seasonality because more than 15 years ago, markets were really different from today. Okay. Anyway, it's up to you. You can use everything you want, and you can find a way to use the forecaster. No worries. What is the seasonality? Very simple. As you can see here, what does 3, 5, 7, 10, and 15 years means? Very simple. For example, in the 3 year seasonality, we take from the chart of the S&P 500 from 1st of January until the end of December for the last 3 years. So in this case, we have 2024, 2023, and 2022. And we simply do the average of all this chart, and we have an average. Okay. So in this case, as you can see, is always really nice to see this kind of chart because, as you can see, even if you use the last 3 years in order to have an average of what happened on the S&P 500, or you use a 15 years average, actually you can find the same trends during the years. Okay, try to imagine, probably you already know seasonality, but if not, it's very simple how to use this very nice tool. It's very simple because, for example, on the S&P 500, as you can see, even if you use the last 3 year average or the last 10 years average, you can definitely say that starting from the end of January until the mid of March, you have a downward movement. You can say something similar but opposite, for example, here. As you can see, using the last 3 year seasonalities, which is the average of the last 3 years, or the last 10, 15 years, you can definitely say that you can find the same trend, for example, in a period, in a window period, which is between the very beginning of May and the very beginning of September. Okay. And this is something amazing because when you do the average of a such long period of time and you can find the same trend both on the last 3 years and the last 15 years, it means that we have a seasonal pattern on a index like the S&P 500. Just to be 100% clear, you can find this kind of trends on every financial instrument across the globe. Also on FX, also on stocks, also on everything. Many people think that this kind of trend, this kind of seasonality are only on commodity, it's not true. You can find seasonality on every instrument all across the globe. Okay? So, for example, in this case, we know that we have specific pattern during the years, and of course, you can scroll down. Look, we can just close this specific highlight, because as you saw, if you go directly on the chart, you can ask to the forecaster terminal um, specific statistics about a specific time frame, a specific period of the year. But if you just scroll down the page without highlight any parts of the chart, you can find the average for a daily average. Let's go here and let's switch off 15 years so we don't get confused. For example, now we are in April. We are on the 29th of April, and here you have the statistic for this specific date. So, for example, if you go back 3 years, only 50% of time, this specific day was a long day. If you go back 5 years, on average, in the last 5 years, the day 29 of April was long 75% of time. In the last 7 years, 80%. In the last 10 years, 57%. You can also find the weekly average. You can also find the monthly average. Okay. So, for example, what is very interesting, since we are approaching summer, talking about the S&P 500, in the last 3, 5, 7, and 10 years, every July were a long period, were a long month, okay? And this is an amazing statistics in order to understand if it's time or not to buy a specific time frame, okay? At the moment we are in April, next month will be May. May, we can definitely say it's a bullish period for the S&P 500, okay? Of course, you can also highlight a specific period, okay? And you can have specific statistic for this specific period, okay? And for example, here you can see that in this specific period, in the last 3, 5, 7, 10 years, you had 100%, 80%, 85% of time, 80% of bullish prices, and you also have the average return. What is very interesting, for example, in this case, is that we have an average return which is very similar, even if we use only 3 years and we use 10 years, okay? It means something really easy. In this specific time frame, in this specific period of time, we have a recurring pattern in prices for the S&P 500. What is very interesting, for example, is the correlation. At the moment, for example, we know that the current prices, which is the current year for the S&P 500, is very highly correlated only with the 3-year seasonality. So, for example, in this case, what we can see, what we can do is something very easy. We can switch off all the other seasonalities, because we know, thanks to the correlation, that the current year is moving very similar, 79% similar, like the S&P 500 did on average in the last 3 years, okay? We can also add the last year, and we can see that the current year is moving very, very similar like it did in the last year, 71%, and in the last 3 years on average, okay? This is an amazing information because, for example, if we highlight on the chart starting from today until the mid of July, we can definitely see what we can expect from the prices, because we know that today prices are moving exactly like they did in the last year and like they did in the last 3 years on average. And so we can definitely see what we can expect starting from today until the end of July. I think I said, yes, July. Okay. And this is a very powerful tool because we know exactly, thanks to the seasonalities and the different seasonalities, if a specific period of time is bullish or bearish, okay? So for example, we go here, we know that May, it's a very bullish month, but we can also see, and we can also be more specific, and we can say, okay, but we know in the past the S&P 500 was very bullish in this specific period, but today we know that the S&P 500 is moving like it did in the last 3 years and in the last year, so we can be more specific in order to get statistics, in order to try to guess what we can expect from the market. Okay, is everything clear, guys? Since now, let me see if you have any specific questions. Damian, what is correlation? As always, guys, remember that you always have the info box where we explain everything. The aim for the Forecaster Terminal is not to be a black box. We really care you understand everything about the software, and we share all the formulas and datas you find on the Forecaster Terminal. We really want you to understand what you are looking for, and this is why we always explain what you are looking for. So for example, correlations show how two things move together. If they are positively correlated, when one goes up, the other usually goes up too. Very simple. We use the Pearson formula to measure the relationship between the current price and different seasonal patterns. It tells us how closely changes in one thing's match changes in another, and is calculated over 60 business days. Okay. If you would like to be more specific, okay, you can go to Google and you can write Pearson correlation, Pearson formula, and as you can see, you will find exactly the formula we use in order to understand if a specific, let's say, line, because we are comparing lines, are moving with or without a correlation. So for example, in this case, we can see that the correlation is quite high, okay? And you will find the green, which means high correlation, when the correlation is above 70%. You will find you will find yellow correlation, so which is not good or bad, when the correlation is between 30 and 60, okay, and 70, and you will find bad correlation when it's below 30%. For example, in this case, if you leave only the 10-year seasonality, we can definitely say that the current year is badly correlated with the 10-year seasonality. It means that if you take what happened on average in the last 10 years, we have a bad correlation. This is why it's better to focus on what happened in the last 3 and the last year, because we know that right now prices of the current year are moving with a high correlation with the last and the last 3 years seasonality. Okay? Let me see if you have other questions. Okay. Damian, please let me know what you don't understand. If you please try to be very specific with your questions. Let me see. Okay. If you go here, you can find the trended version of the seasonality. If you click it, very simple, you take away the trend from these lines. Okay? What does it mean? Very simple, also in this case. If you go to Google and you write the trended price oscillator, you will find on Wikipedia, for example, a specific technical analysis indicator, which is very simple indicator because it goes on the chart you are looking, and it will take away, sorry, not take off, take away the trend. Okay. For example, here you have an example of a chart, and here below you can find the trended version of this chart. As you can see, highs and lows are the same you can find on the chart, but the aim of the trended price oscillator is to create a chart without a trend, so you can understand if there is a specific, let's say, trend, a cyclical pattern inside this chart. Okay. So, for example, in this case, as you can see, if you take away the trend from this seasonality, you can be more specific in analyzing and finding lows and highs. Okay. Very simple. This is something very simple. And I mean, to be completely honest with you, I don't use the trended version so often, because what I'm looking inside the seasonality is a specific trend in a specific moment. Okay. So, for example, let's be very practical. What can we say regarding S&P 500 seasonality at the moment? Simple. Look, if we go here, we know that the current year is moving 79, more, almost 80% like the 3-year seasonality. Okay. So we can do something interesting. We can leave only the 3-year seasonality. And for example, in this case, we can highlight this specific period on the chart. And as you can see, we can find a little downtrend. Okay. And we can be more specific in analyzing this period. Look, in the last 3 years, if we have been short, okay, 66% of time we had a profit with an average return of 4.6%. Okay. If we, in the same period, have been long, we had only 33% of profit with an average return which dropped to 2.4%. What this data means is very simple. We are talking about this specific period of time in a moment where a drop in prices for the S&P 500 is more is more probabile, possible. Thank you, Michele. Is more possible than an upward movement. Okay. Yes, we have, as Anil is writing in the chat, a higher probability for a downward movement in this specific period than an upward movement, because both the winning rate and the average return increase if we highlight a short trade. Okay. As you can see, you can use this specific tool for the S&P 500, but you can use seasonality for all the others instruments, and of course we will do example during this masterclass. Okay. Of course, we can also we can also focus our attention not on let's say these short periods, okay, but of course we can also focus on more long-term chart. And in this case, for example, we can definitely see that during a specific period, which is between the, let's say, middle of May and the middle of August, we have a very bullish period, because in the last 3 years, 100% of time in this specific period, we had an upward movement with an average return of 7.5%. Okay. If we add, for example, 5-year seasonality, the 7-year seasonality, the 10-year seasonality, we can definitely say that exactly like the 3-year seasonality, during this specific period, they moved very similar. Okay. So we can go here and we can check the statistics, and we can say that it's high, we have a very high probability that during this specific window of time, we will have an upward movement. Okay. Why? Because in the last 10 years, we had 90% of time a bull trend with an average return of 6.5%. Okay. And look, the only year just below the statistics, we add all the single year divided. Okay. The only one year where we add a negative return, it's 2015, and the negative performance is only minus 0.14%. Okay, which is actually, we can say, it's not negative. Okay, because it's a very low negative performance. Okay, so in this case, we know that in this specific period we have a very bullish probability okay? And at the moment, we also know that prices are moving very, very close how they moved in the last 3 years on average. And so we can definitely say that this is the return we can expect in this specific period. Okay? Is it clear, guys? Seasonality? Perfect. Now we can switch to another layer, okay? Because we can go to do a more in-depth analysis using, for example, the overbought and oversold. Overbought and oversold is a more statistical, technical, mathematical approach. If with seasonality, we use all the data coming from the past in order to understand if we have a specific pattern or not. With overbought, oversold, we use different kinds um, of indicators. All these indicators are based on statistical and mathematical data. Okay, so let's go, for example, here. What we can find is this indicator, which is the market mood meter. It's a very nice indicator. It's something inspired by the fear and greed index, which is an indicator made by the CNN. And this indicator is telling us if at the moment in the market we have fear or greed. Okay? In general, when on the market we have fear, it's time for a low to be made. When we have extreme greed, it's time for a top to be made on the market. Okay, this is exactly the same concept, but this indicator is created with the technical and mathematical and statistical analysis. And what is really nice, you can find also an historical chart for this data. And of course, what you can find is that it's very interesting when prices goes in the lower part of the chart, because in general we can find lows on the S&P 500, but it works for all the other instrument, where when of course this kind of when prices um, sorry again, I start again. um, as you can see, when the market mood meter is in the lowest part of the quadrant, as you can see, the markets tend to do very important lows. Okay, this market mood meter is a combination of three different um, indicators. We have the advanced DPO, which is the indicator you can find here, which colors the chart with green, blue, orange, and red. It depends if the prices are overbought or oversold. It's a combination also of Wyckoff. Wyckoff is a very interesting indicator. Of course, guys, everything is explained. Okay. So, for example, talking about the Wyckoff, it's a very interesting indicators because it tells us if the numbers of buyers are exceeding the number of sellers and vice versa, of course. So, for example, as you can see here, you have a zero line. When the indicators stay on zero, it means that exactly in that moment we have the same numbers of buyers and sellers. What is very important, we use these indicators like we always used all the technical analysis indicators. We search for divergency. So for example, in this case, as you can see on the S&P 500, even if the prices were dropping down, okay, we have the number of buyers which are increasing, okay? Very simple. We also have the speed, which is another indicator where we find, where we try to find divergences thanks to this indicator. Give me a second. Okay, perfect. This is another indicator that works the same like the Wyckoff, but as you can find here in the description, we use the velocity, the speed formula in order to calculate the speed, the velocity of prices, okay? We use the same formula you can use to calculate the speed of a car on the street, but we use it for calculating the speed of prices. You can imagine, for example, you have to imagine this is not a price, this is a car going on the street, okay? What we do with the speed indicator, we calculate the formula, we calculate the speed of the prices. And this is something really interesting because once you calculate the speed of prices, you can definitely find some specific moments, okay, for example, like it happened here on the top for the S&P 500, where the speed of prices start to drop, but the prices continue to go up. And here we can find what we call a divergency, because prices are going up, but at the same time, the speed is telling us that something inside the trend is changing, okay? And that's it. And this is something really important because we can definitely analyze how prices are moving and we can understand if it's time or not to buy, okay? Market mood meter is a sum of all these three indicators: advanced DPO, Wyckoff, and speed. And we have just one indicator that is telling us what is happening on the market. And as you can see, here we had, for example, a first important low here with the indicator that drop below the minus 100 level. And then we started to have divergences between the indicator and prices. And this is what we are looking for. When we start to see divergences on between the indicator and the prices, we can definitely say we are close to an inversion in prices, okay? Of course, you can use this indicator just to understand and just to know we are close to a low, or as we explain on our website, you can go on Forecaster.biz website and you can go, for example, in market mood indicator. We explain with a real example how to use this indicator in order to get a timing signal, a buy entry point or a sell entry point if you are on tops, okay? So in this case, very easy, talking about the S&P 500, we can definitely say that we experienced in the recent weeks a oversold situation, And an oversold situation, which also called panic selling, is a specific moment where markets tend to perform a lows, okay? Tend to tend to do a very important low. And this is why at the moment we can definitely say that the oversold and overbought analysis we just did, it's in line with the analysis we did with the seasonality. Okay, that's it. Okay, if you if these two different analyses we did with the forecaster is not enough for you, you can also go deeper and you can also go to the COT report. And for example, in this case, you can find something very interesting because you can find all the participants at this huge market, which is the futures of the S&P 500. And for example, in this case, you can find a very interesting situation. Let's go back very quickly to the CFTC Commission website. And for example, here you go to financials, okay? You can find all the futures for the CME, okay? You can find everything. And of course, you will find, if you scroll down, you can find also the S&P 500. Here you have, for example, the long position for the leveraged fund and the short positions, okay? This is not a very nice page where to understand how they are trading on this specific market because you can find just one data, okay? What we do at Forecaster, we collect all the historical data and we plot the data on the chart. And what we do is trying to understand if we have a divergence between prices and the volumes of a specific category. For example, talking about the S&P 500, we always look for leveraged fund. We are talking about the hedge funds and non-commercial. Also in this case, guys, you have the description of what you are looking at directly inside the forecaster, okay? So for example, if we would like to analyze the COT report for the S&P 500, we can definitely say something really interesting because look, these are the net positions. It means we here on the chart we find long positions minus the short position for this specific category, leveraged fund. Okay, we have both the long, the short. We can also see a different kind of chart. I really love the bar chart in this case. The net position are the long contracts minus the shorts. What we can see here is something really interesting because during the last drop in prices, hedge funds closed a lot of short positions. And this is something really interesting because as you can see, we have a very strong divergence in this case. And this is another analysis on another layer in the forecaster that tell us that probably we are on a very important low for the S&P 500, okay? Of course, you can go deeper for the COT report and you find a complete course, a complete masterclass about the COT report here. You find it inside your forecaster terminal and you find a complete COT report course, okay? Don't worry because we will have a look to COT report even in the next chapter of this masterclass because COT report is very important for example, for commodities, currencies, and all the future available on the CME. Okay, but talking about the S&P, we have a divergence because during the last drop in prices, the leveraged fund used the last drop in order to close a lot of short positions, and this is a bullish sign. Okay, if you have not enough analysis, you can also go to the ranking page where we can find something really amazing. Because inside the forecaster terminal, we have for every single stocks listed across the globe, we have the fair value automatically calculated by the forecaster. What we do for every index is taking all the companies, the components for the index, and calculate the average fair value for the entire index. And in this case, we can definitely say that the entire S&P 500 is undervalued by 60%, 16%, which is something really amazing that tell us that probably we are on a very important low because we have an index where the companies are making money, as you can see from the global net income for the S&P 500. But fundamentally speaking, we are talking about an index which is undervalued by 16%. And this is a very nice layer, the ranking, because you can analyze only the top 10 shares and they are undervalued too. And you can find the pie chart that tell you how the sector are divided. You can analyze the top 30, you can analyze the top 50, and you can analyze a specific sector. For example, if you would like to have a look inside the healthcare, we can definitely say that the healthcare sector is really undervalued. Okay? If we go, for example, here to all shares, all stocks, here you can find the value layer where you can find all the fundamental analysis factors. We will deep dive inside this page when we will talk about the next week regarding shares and companies. You have the ratios, the traditional ratios, and you also have the price change, the performance for the stock. Okay. On every layer, you find the best to worst button. If you click the best to worst button, very easily you can find which are the best companies ranked by average of these datas, both on value, ratios, and price change. Okay, guys, for today's we have to stop here, but be sure to come next week because we will deep dive again inside this masterclass regarding the forecaster terminal. I hope you enjoyed. See you next week. Thank you very much and see you next week. If you have any questions, please send your question to info@forecaster.biz. I will be more than happy to reply to you.